Question 1. An insured's homeowner policy specifies that the dwelling coverage is $200,000 and the personal property coverage is 50% of the dwelling coverage. If the policy has a standard deductible of $1,000 and the insured suffers a covered loss of $30,000 to their personal property, how much will the insurer pay, assuming no other limits apply? A. $15,000. B. $29,000. C. $30,000. D. $100,000. Answer: B. $29,000. The personal property coverage is 50% of $200,000, which equals $100,000. Since the loss is $30,000, it is well within the $100,000 personal property limit. After applying the $1,000 deductible, the insurer will pay the loss amount minus the deductible, resulting in a payment of $29,000. Remember that the deductible is the amount the insured must pay out of pocket before the insurance policy begins to pay for a covered loss. Always subtract the deductible from the covered loss amount to determine the insurer's payment. Question 2. Which of the following is considered an unfair trade practice in Georgia when an agent induces an insured to lapse, forfeit, or surrender an existing policy for a new one to the insured's detriment? A. Rebating. B. Twisting. C. Misrepresentation. D. Defamation. Answer: B. Twisting. Twisting is an unfair trade practice where an agent persuades a policyholder to drop an existing policy and replace it with a new one, often to the policyholder's disadvantage, purely to generate a new commission for the agent. This practice involves making misleading comparisons or incomplete statements to convince the insured. Agents must always act in the best interest of the client, and encouraging a financially detrimental policy change is a serious violation. Always ensure that any policy change genuinely benefits the client, not just the agent's commission. Question 3. Under a standard personal auto policy, PAP, in Georgia, which of the following coverages is designed to pay for damage to the insured's vehicle caused by a collision with another car or object? A. Other than collision, comprehensive. B. Medical payments. C. Collision. D. Uninsured motorist. Answer: C. Collision. Collision coverage in a personal auto policy specifically pays for damage to the insured's car resulting from an impact with another vehicle or object, or from the car overturning. This coverage is typically optional and subject to a deductible, meaning the insured pays a portion of the loss. Other than collision, comprehensive, covers different types of damage, like theft or hail, while medical payments covers bodily injury to occupants, and uninsured motorist covers injuries from drivers without sufficient insurance. Think of collision as covering direct impact damage to your vehicle. Question 4. What is the primary purpose of the Georgia Valued Policy Law? A. To require insurers to pay the full policy limit for total losses to personal property. B. To mandate that insurers pay replacement cost for all covered losses. C. To specify that insurers must pay the full policy limit for total losses to real property in certain circumstances. D. To allow insurers to pay less than the actual cash value for total losses. Answer: C. To specify that insurers must pay the full policy limit for total losses to real property in certain circumstances. The Georgia Valued Policy Law dictates that if a total loss occurs to insured real property, like a building, due to a covered peril, and the property is situated within Georgia, the insurer must pay the full amount for which the property was insured at the time of the loss, regardless of its actual cash value or replacement cost. This law is designed to prevent insurers from collecting premiums based on a certain valuation and then paying less than that amount for a total loss. This law specifically applies to structures, not personal property, ensuring homeowners receive the agreed-upon value if their home is completely destroyed. Question 5. In property and casualty insurance, what does actual cash value, ACV, typically represent? A. The cost to repair or replace property with new materials of like kind and quality, without deduction for depreciation. B. The agreed-upon value between the insurer and insured at the time the policy is issued. C. The replacement cost of the property minus depreciation. D. The market value of the property at the time of loss. Answer: C. The replacement cost of the property minus depreciation. Actual cash value, ACV, is a common method for calculating loss payments in property insurance, representing the cost to replace the damaged or lost property with new property, minus an allowance for depreciation, wear and tear, age, obsolescence. This method aims to put the insured back in the same financial position they were in just before the loss, without allowing them to profit from the loss. For instance, if your 5-year-old couch is destroyed, ACV would pay what a 5-year-old couch is worth, not a brand new one. Remember that ACV considers depreciation, unlike replacement cost. Question 6. A business owner in Georgia wants to purchase insurance that protects against claims arising from injuries or damages sustained by third parties due to the business's operations or premises. Which type of policy would best fit this need? A. Commercial property policy. B. Business auto policy. C. Workers' compensation policy. D. Commercial general liability policy. Answer: D. Commercial general liability policy. A commercial general liability, CGL, policy provides broad coverage for a business's legal liability to third parties for bodily injury and property damage arising from its premises, operations, products, or completed operations. This is crucial for protecting the business from lawsuits and claims from customers, visitors, or others who might be injured or have their property damaged by the business's activities. Commercial property covers the business's own assets, business auto covers its vehicles, and workers' compensation covers employee injuries, so CGL is the appropriate choice for third-party liability. Question 7. All of the following are typically considered supplementary payments under a standard liability policy in Georgia except: A. Defense costs for the insured. B. Premiums on appeal bonds. C. Loss of earnings for the insured while attending court at the insurer's request. D. Damage to the insured's property. Answer: D. Damage to the insured's property. Supplementary payments in a liability policy are additional amounts an insurer will pay on behalf of the insured beyond the policy's liability limits, typically related to the defense and investigation of a claim. These often include defense costs, premiums on appeal bonds, and reasonable expenses, including loss of earnings, incurred by the insured while assisting the insurer with legal proceedings. Damage to the insured's own property, however, is not a supplementary payment. It would fall under a separate property coverage section if purchased, as liability policies primarily cover damages to third parties. Question 8. In Georgia, what is the role of the Commissioner of Insurance? A. To write new insurance laws and regulations. B. To represent insurance companies in legal disputes. C. To enforce insurance laws, regulate insurers, and protect policyholders. D. To set insurance premium rates for all lines of business. Answer: C. To enforce insurance laws, regulate insurers, and protect policyholders. The Georgia Commissioner of Insurance is the chief officer responsible for overseeing the insurance industry within the state. Their role includes enforcing the Georgia Insurance Code, issuing licenses to agents and insurers, approving policy forms and rates, investigating consumer complaints, and ensuring that insurers remain solvent and fair in their practices. While they can propose new laws, their primary role is enforcement and regulation, not writing new legislation. The Commissioner acts as the public's advocate, safeguarding their interests in insurance matters. Question 9. An insurance policy is considered a contract of adhesion because: A. It can be transferred from one insured to another. B. It is prepared by the insurer with little or no negotiation by the insured. C. It requires both parties to perform certain duties. D. It is an exchange of an unequal amount of money. Answer: B. It is prepared by the insurer with little or no negotiation by the insured. A contract of adhesion means that one party, the insurer, drafts the contract and the other party, the insured, must adhere to it, meaning they accept the terms as written or reject the entire contract. There's typically no negotiation over the specific wording of the policy. Because of this characteristic, courts often interpret any ambiguities in the policy in favor of the insured, who had no power in drafting the terms. This concept ensures that policyholders are not unfairly bound by unclear language they couldn't influence. Question 10. Under a business auto policy, BAP, which symbol provides the broadest coverage for an owned vehicle? A. Symbol 1, any auto. B. Symbol 2, owned autos only. C. Symbol 3, owned private passenger autos only. D. Symbol 7, specifically described autos. Answer: A. Symbol 1, any auto. Symbol 1, any auto, is the broadest designation for covered autos under a business auto policy because it includes all owned, leased, hired, or borrowed vehicles, as well as non-owned autos. This symbol offers the most comprehensive coverage for liability, as it encompasses virtually any vehicle the business might use. Other symbols like owned autos only or specifically described autos are more restrictive, covering only certain types of vehicles. When you see any auto, think of it as the ultimate blanket coverage for liability. Question 11. What is the purpose of the coinsurance clause in a commercial property insurance policy? A. To prevent the insured from being overinsured. B. To encourage the insured to insure the property to a certain percentage of its value. C. To provide additional coverage beyond the policy limits. D. To reduce the premium for the insured. Answer: B. To encourage the insured to insure the property to a certain percentage of its value. The coinsurance clause in commercial property insurance is designed to encourage policyholders to insure their property for an amount close to its full value, typically 80% or 90%. If the insured carries less than the required amount of insurance, they will be penalized at the time of a partial loss and will have to bear a portion of the loss themselves, even if the loss is less than the policy limit. This mechanism helps ensure that insurers receive adequate premiums for the exposure they cover, as underinsured properties lead to inadequate premiums for the full risk. Always remember that coinsurance penalties only apply to partial losses if the property is underinsured. Question 12. Which of the following statements about an insurance binder is true? A. A binder is a permanent insurance policy. B. A binder guarantees coverage for a maximum of 30 days. C. A binder provides temporary insurance coverage until a formal policy is issued. D. A binder can only be issued by the insurance company's home office. Answer: C. A binder provides temporary insurance coverage until a formal policy is issued. An insurance binder is a temporary agreement that provides proof of insurance coverage for a specific period, typically 30, 60, or 90 days, while the actual policy is being processed and issued by the insurer. It acts as a placeholder, offering immediate protection to the insured for perils covered by the anticipated policy. Binders are crucial for ensuring continuous coverage, especially when purchasing a new home or vehicle, and they can be issued by authorized agents. Remember, a binder is proof of temporary coverage, not a permanent policy. Question 13. Which type of bond guarantees that a contractor will perform a contract according to the terms and specifications agreed upon? A. Fidelity bond. B. Surety bond. C. Performance bond. D. Judicial bond. Answer: C. Performance bond. A performance bond is a specific type of surety bond that guarantees a contractor will complete a project or fulfill a contract according to the agreed-upon terms and specifications, including quality and timeliness. If the contractor fails to perform, the obligee, the party receiving the work, often a project owner, can make a claim against the bond to compensate for the contractor's non-performance. Fidelity bonds protect against employee dishonesty, while judicial bonds are used in legal proceedings. Performance bonds are essential in construction and public works contracts. Question 14. What does subrogation mean in an insurance policy? A. The insured's right to choose their own repair shop after a loss. B. The insurer's right to recover payment from a third party who caused a loss. C. The insured's obligation to report a loss promptly. D. The insurer's duty to defend the insured in a lawsuit. Answer: B. The insurer's right to recover payment from a third party who caused a loss. Subrogation is the legal right of an insurer to step into the shoes of the insured after paying a claim and pursue recovery from a third party who caused the loss. For example, if your car is hit by another driver and your insurer pays for the damages, the insurer then has the right to sue the at-fault driver to recover the money it paid out. This principle prevents the insured from collecting twice for the same loss, once from their insurer and once from the at-fault party, and places the financial burden on the responsible party. Subrogation helps control insurance costs by shifting the ultimate responsibility for a loss to the negligent party. Question 15. In Georgia, an agent's license may be revoked or suspended for which of the following reasons? A. Failing to attend a company sales meeting. B. Misappropriating premiums collected from an insured. C. Not meeting a sales quota. D. Being late to renew a license by 1 day. Answer: B. Misappropriating premiums collected from an insured. Misappropriating premiums, which means improperly using or stealing funds collected from an insured, is a serious violation of an agent's fiduciary duty and a direct cause for license revocation or suspension by the Georgia Commissioner of Insurance. Agents hold a position of trust, responsible for handling client money responsibly and ethically. Failing to meet sales quotas or being slightly late on renewal are typically not grounds for revocation, although penalties may apply for late renewals. Maintaining public trust through ethical conduct is paramount for licensed agents. Question 16. Which type of hazard is represented by a dishonest act, such as filing a fraudulent claim? A. Physical hazard. B. Moral hazard. C. Morale hazard. D. Legal hazard. Answer: B. Moral hazard. A moral hazard refers to an increase in the probability or severity of loss due to an individual's dishonest tendencies, such as filing a fraudulent claim or intentionally causing a loss to collect insurance money. This contrasts with a morale hazard, which is an indifferent attitude towards loss, and a physical hazard, which is a tangible condition that increases the chance of loss. Moral hazards are rooted in character and integrity and are a significant concern for insurers, as they directly impact the potential for intentionally fabricated losses. Question 17. What is the primary function of the Georgia Auto Insurance Plan, GAAP? A. To provide a competitive market for high-risk drivers. B. To ensure that all Georgia drivers can obtain at least minimum liability insurance coverage. C. To reduce auto insurance premiums for good drivers. D. To offer comprehensive coverage to drivers who are denied by standard insurers. Answer: B. To ensure that all Georgia drivers can obtain at least minimum liability insurance coverage. The Georgia Auto Insurance Plan, GAAP, is the state's assigned risk plan, designed to provide automobile liability insurance to drivers who are unable to obtain coverage in the voluntary market due to their poor driving records or other high-risk factors. It acts as a last resort market, ensuring that even high-risk drivers can meet the state's mandatory financial responsibility laws for auto insurance. All admitted auto insurers in Georgia share in the results of this plan, distributing the burden of insuring these drivers. It guarantees access to essential coverage, not necessarily comprehensive or lower premiums. Question 18. What is the peril in an insurance policy? A. The cause of loss, such as fire or theft. B. The condition that increases the likelihood of loss. C. The financial consequence of a loss. D. The type of property being insured. Answer: A. The cause of loss, such as fire or theft. A peril is the direct cause of loss, meaning the event that actually leads to damage or injury. Common perils in property and casualty insurance include fire, windstorm, hail, theft, collision, and liability. In contrast, a hazard is a condition that increases the likelihood or severity of a loss, but it is not the loss itself. Understanding perils helps define what specific events a policy is designed to cover, as policies often list covered perils or state what perils are excluded. Question 19. Which of the following is typically covered under coverage C, personal property in a homeowner's (HO) policy? A. The dwelling itself. B. Other structures on the property, like a detached garage. C. Furniture, clothing, and electronics owned by the insured. D. Land on which the dwelling is located. Answer: C. Furniture, clothing, and electronics owned by the insured. Coverage C of a homeowner's (HO) policy is specifically designed to cover the insured's personal property, which includes items like furniture, clothing, appliances, and electronics, regardless of whether they are at the insured's home or elsewhere in the world. The dwelling, coverage A, and other structures, coverage B, are separate coverages within the policy. Personal property coverage is typically a percentage of the dwelling coverage and is subject to certain limitations for specific types of valuable items. Question 20. An insured suffers a fire loss to their home. The insurance company pays the claim and then seeks to recover damages from a negligent third party who caused the fire. This action is based on the principle of A. Indemnity. B. Adhesion. C. Subrogation. D. Utmost good faith. Answer: C. Subrogation. This scenario perfectly illustrates the principle of subrogation, where the insurer, after paying a claim to its insured, gains the right to pursue recovery from the third party responsible for the loss. This ensures that the at-fault party ultimately bears the financial responsibility, preventing the insured from double recovering for the same loss and helping the insurer recoup its payments. Indemnity ensures the insured is made whole but not overcompensated, while adhesion relates to contract formation, and utmost good faith refers to the honesty required from both parties. Question 21. What is the standard deductible applied to most homeowners policies in Georgia, if not specified otherwise? A. Percentage deductible. B. Flat dollar deductible. C. No deductible. D. Peril-specific deductible. Answer: B. Flat dollar deductible. Most standard homeowners policies in Georgia and across the U.S. apply a flat dollar deductible, which is a specific dollar amount the insured must pay out of pocket for each covered loss before the insurer begins to pay. While some policies might have percentage deductibles for specific perils like wind/hail, the general deductible applied to most other covered losses is a fixed dollar amount, such as $1,000 or $2,500. This fixed amount is clearly stated in the policy's declarations page and applies to the overall claim. Question 22. Which of the following describes an unilateral contract in insurance? A. Both parties make legally enforceable promises. B. Only the insurer makes a legally enforceable promise. C. The contract can be cancelled by either party at any time. D. The contract is negotiated equally by both parties. Answer: B. Only the insurer makes a legally enforceable promise. An insurance policy is considered a unilateral contract because only one party, the insurer, makes a legally enforceable promise to pay covered claims. The insured pays the premium and fulfills conditions, but they are not legally obligated to continue paying premiums or maintain the policy. However, if the insured does pay the premium and meet the conditions, the insurer must perform its promise to pay covered losses. This characteristic means the insurer is bound by its promise, but the insured is not legally bound to pay future premiums. Question 23. The insuring agreement in an insurance policy describes A. The effective date and policy period. B. The parties to the contract and policy limits. C. The perils insured against and the insurer's promise to pay. D. The duties and obligations of the insured. Answer: C. The perils insured against and the insurer's promise to pay. The insuring agreement is the heart of an insurance policy, outlining the core promise of the insurer to pay for losses that fall within the scope of the policy. It clearly states the perils or types of losses that are covered and defines the coverage provided, often using terms like, "we will pay," or "we agree to indemnify." This section is crucial because it establishes the primary contractual obligation of the insurance company. Think of it as the "what is covered" section of your policy. Question 24. What is the primary purpose of the "other insurance" clause found in many property and casualty policies? A. To determine if the insured has multiple policies covering the same loss. B. To prevent over-indemnification when multiple policies cover the same loss. C. To allow the insurer to deny a claim if other insurance exists. D. To encourage insureds to purchase multiple policies. Answer: B. To prevent over-indemnification when multiple policies cover the same loss. The "other insurance" clause is designed to prevent an insured from collecting more than the actual loss amount when multiple insurance policies cover the same property or liability exposure. It specifies how multiple policies will contribute to a loss, typically using methods like pro rata. Each policy pays its share based on its proportion of the total insurance, or primary/excess. This clause upholds the principle of indemnity, ensuring the insured is made whole but does not profit from a loss by collecting from multiple sources. Question 25. Under Georgia law, an insurance agent's license may be suspended or revoked if the agent engages in rebating. What is rebating? A. Offering an insured a special inducement not specified in the policy, such as a portion of the commission. B. Spreading false or malicious information about another insurer or agent. C. Charging different premiums for insureds in the same class and with the same hazard. D. Misrepresenting the terms, benefits, or conditions of an insurance policy. Answer: A. Offering an insured a special inducement not specified in the policy, such as a portion of the commission. Rebating is an illegal practice in Georgia where an agent offers an insured an inducement, benefit, or valuable consideration not specified in the insurance policy itself, often in the form of a return of a portion of the premium or commission, to persuade them to buy insurance. This practice is prohibited because it can lead to unfair competition, discrimination among policyholders, and a potential reduction in the quality of advice given. Agents must only offer what is stated in the policy and avoid any unapproved financial incentives.